I'm deeply interested in how banks move and evolve. If you follow the way I think, you'll understand why that matters. Ever since Bitcoin came onto the scene, people have debated whether to view it primarily as a monetary phenomenon or as a breakthrough in technology called blockchain. That divide has persisted. Ideally, we'd embrace both perspectives. So why the conflict? Honestly, there's no good reason. But this divide mainly comes from two sides. First, in the financial sector, including institutions like Goldman Sachs and the mainstream media, who struggled to grasp the phenomenon and instead framed it in ways that fit their existing worldview. I call those media outlets and knowledge groups average brains, and that framing makes perfect sense to the average brain. They say this is just tech innovation, no, not a monetary revolution. Then there's another camp. They ran with the slogan Blockchain 2.0, which was brilliant marketing. They branded their movement with that label. And in doing so, they labeled Bitcoin as Blockchain 1.0, something outdated and obsolete, and they benefited from that framing big time. So between those two forces, media narratives and marketing, governments, banks, and the media work to suppress the monetary narrative, steering the conversation toward blockchain as a pure tech innovation. Ethereum and its ecosystem aligned with that vision and ran with it. As a result, the monetary essence of Bitcoin one is now almost completely missing from the public conversation. Most people don't even perceive Bitcoin as a monetary phenomenon anymore today. When you try it out yourself and think, wow, this is taking forever, it's usually because you're sending and receiving on an exchange. Even the most advanced coins can take a while to transfer on an exchange. And the reason is simple. Exchanges intentionally delay transactions to protect against hacks. In the early days, there were a lot of misconceptions. Concepts like a 51% attack, they're not exactly easy to grasp. They're far from intuitive. So people tried to understand it like Satoshi's disciples, engineers really. They figured, before 6 blocks are confirmed, the transaction is unstable. That became the conventional thinking. That's why exchanges insisted on waiting for 6 confirmations early on. Even if I sent Bitcoin to an exchange, it wouldn't show up in my exchange account until those 6 confirmations were done. Even when withdrawing, they'd hold it back until the 6th block was confirmed. But over time, as exchanges got hacked more and more, to stop hackers from quickly depositing and withdrawing funds, whether Bitcoin, Bitcoin Cash, or Ethereum, they started setting longer delays. When you request a transaction, it takes forever now. Lately, I think it's also to prevent arbitrage trading. If there's a price difference between exchanges, people can profit off it. So to stop people from buying here and selling there instantly for a profit, some coins are even delayed by a full day. What you should really do, like I've done, is send and receive Bitcoin directly from one smartphone wallet to another. But honestly, I can't expect you to do that right now because the fees are just way too high. It's frustrating when you send 0.001 BTC and pay 0.001 BTC just in fees. You lose as much in fees as you're trying to send. Bitcoin transaction fees aren't based on the amount you send. They're based on data size. Whether you send 10,000 BTC or 0.001 BTC, the data size is nearly the same. Yeah, so I get it. You probably haven't tried it, but back in 2014, as I mentioned, I met people and personally sent them Bitcoin worth about $1,000. I experienced it all firsthand. Back then, the fees were low and overall coins were cheap. If I sent $1 worth of Bitcoin, I'd pay just 10 cents in fees. So I'd send people $1, $2, even $10 worth just to show how it worked. They experienced how instant it was, and so did I over and over. But now the whole idea of Bitcoin as a monetary phenomenon has been erased from our collective understanding. So what's left in people's minds is just, blockchain, just another tech innovation. And when you hear me talk, it might sound a bit strange or unfamiliar. I think a lot of Ethereum fans really misunderstand me when they hear this. If you look at the OCC letter, specifically the one from last year, it says banks can offer custody services, but they're not allowed to actively manage the assets. So what does don't manage actually mean? Normally, when you deposit something in a bank, they invest or lend it out, right? It's not like a pawn shop that just holds on to stuff, but the OCC says don't do that. It doesn't mean they can never do it, since it just means not for now. So even if banks hold Bitcoin or Ethereum in custody, they're not allowed to generate derivative credit from it. In plain terms, they can't lend it out. All they can charge is a storage or service fee. But with Ethereum 2.0, this becomes a golden opportunity for banks, because if you stake Ethereum, it generates yield. So JP Morgan, for example, can recommend Ethereum, even to retirees and older clients. With this, if you hold it, say you stake 32 ETH, you'll earn a certain yield. But for an individual to stake Ethereum, they need the full 32 ETH minimum. That's not a problem for a bank though, right? The OCC letter says they must hold assets on a one-to-one basis. In other words, if a client deposits 10 ETH, the bank has to hold exactly 10 ETH in its vault. But that doesn't rule out staking. It just means the asset is locked for a certain period. But it's still under the bank's control. It's not outside their management. They can pool funds, 5 ETH from one person, 10 from another, and meet the staking minimum that way. And then they can share the staking rewards with the depositors. So basically, a bank can operate like a mining pool. Right now, banks are struggling to survive in the battle against big tech. Tier 1 banks have been a bit slow to catch on. But Citibank, though still a major bank, has been more responsive to these shifts. For JP Morgan, this is a huge opportunity. Ethereum has opened a very promising path forward. Even without issuing credit or derivatives, they can earn interest just through staking. For banks, it's a win. Just holding it brings in yield. They can profit even without creating money through loans or credit. Just by holding it, they earn interest, making it easy to market as a financial product. That's why the banks are reacting positively to this. The market potential is massive. But there's also the government's interpretation to consider. The SEC will have its own stance. If staking rewards are classified as securities, then it becomes an unregistered security issue. There's definitely debate happening around that. Still, it's undeniably attractive for banks, and if staking is allowed, it opens a breakthrough. Ethereum 2.0's shift presents a huge opportunity for the entire financial sector. First of all, that's how banks are perceiving it right now. Of course, if they dig a little deeper, they'll realize Bitcoin can be staked too. Surprisingly, many DeFi algorithms already enable staking with Bitcoin. But for the average person, that's not easy to grasp intuitively. And most of you, let's just say blockchain here, I won't even name Ethereum yet. Ethereum's dilemma is that in fighting Bitcoin big height, they kept shouting, we're not money, we're technology, but they ended up falling into that trap themselves because now they're facing others that are even more tech than they are, like EOS and others, pushing the blockchain 3.0 narrative, and more will come, each one claiming to be faster, cheaper, and more efficient than Ethereum. And the way Ethereum defends itself against that war, when Ethereum and Bitcoin were fighting, Ethereum ends up sounding a lot like what Bitcoiners used to say. So don't be too guarded when you hear what I'm saying. I really hope you'll look at all of this with a broader perspective. And here's what I think a lot of people missed. They rushed into the tech side without fully reflecting on the shockwave Bitcoin created as a monetary phenomenon.